TransMedics stock is down 29% after hours after reporting their third quarter 2024 earnings. This is a high-flying growth stock that is up as much as 240% in the past year. So is this nice little 25% dip an opportunity, or is it just coming back down to reasonable levels? Well, let's find out. So TransMedics, for those unaware, is a growth stock. They, up until now, we're seeing triple-digit revenue growth, and what they sell are these organ transplant storage devices, I would call them. Essentially, it's a little device that keeps an organ fresh as it makes its journey from the donor to the recipient. So a lot of times, at least in the US, what happens is when you go and get your driver's license, you can elect to become an organ donor. In the unfortunate, unlikely event that you might pass away from, let's say, a car accident, that would mean that doctors could come out and essentially, it's kind of gross, but harvest your organs and give them to somebody in need of that particular organ. So a heart, a liver, a new lung, something like that. Typically what they would do is literally put these organs on ice, literally ice, and fly them as fast as possible to the recipient from the donor. What TransMedics is doing is making these devices that are a lot more professional than ice and help expand the lifespan of an organ. So it's kind of a neat device. But why is the stock down almost 30%? Like I said, they just reported their third quarter 2024 earnings results, and they saw growth of 64% year over year. So like I said, high-flying growth stock. That's some great growth, but it's down 30%. And I think the reason for that is explained really well by this chart from TransMedics. Notice something strange about this most recent quarter. It's their first quarter in a very long time where they've had negative quarter-over-quarter revenue growth. So they actually saw less revenue this quarter than they saw last quarter. So sure, it's still up 64% year over year, but it's down from the previous quarter. So oftentimes what you'll find with high-flying growth stocks is that the market expects a lot out of them. When you're a company that's posting triple digit, that's over 100% revenue growth, that means you're more than doubling your revenue year over year, the market expects you to keep going on that trajectory. They don't expect you to double your revenue over and over. That's impossible at a certain point. But they do expect you to keep that revenue growth strong. So to go from triple-digit revenue growth to all of a sudden double-digit 64% revenue growth, yikes, that is a big surprise. And of course, the market did not react too favorably to that. If you ask their CEO, who is also a doctor, he will say that he's proud of the performance this year and is looking forward to ending 2024 on a strong note. So this leads me to believe that they're going to return to growth quarter over quarter in the fourth quarter. But let's take a look. 2024 financial outlook. TransMedics continues to expect revenue for the full year to be in the range of $425 to $445 million, which represents 76 to 84% growth compared to the prior year. Okay, so the next quarter is going to be a bit better, and they have not changed their guidance outlook. So yeah, revenue for this quarter was a bit disappointing, but their full year outlook is the same. So this leads me to believe that perhaps there were some orders that were postponed into the following quarter or even into the next year that maybe impacted the revenue for this quarter. But I think there's also something else that is dragging down the stock, and that would be their gross margins. We saw something similar with Super Microcomputer, where their gross margins were falling as the revenue growth was staying strong, and the market believes that they are going after growth at all costs, right? They're lowering their prices to get growth, but that comes at the expense of your profitability, those nice juicy gross margins, which Supermicro doesn't have. But TransMedics did have. So last year they had 61% gross margins, and those are down to 56%. So they're down 5% year over year. They say the change from the prior year is a result of a higher proportion of service revenue compared to product revenue, which carries a higher margin. In addition, we made investments in our NOP network to prepare for future growth. NOP stands for National OCS Program, and one acronym led us to another acronym. OCS is Organ Care System. So I wish they could have just said that, but they're reinvesting into their platform to fuel future growth. What kind of things are they investing in? Well, they recently bought an airline. Not even kidding. They wanted to improve the time that it took to transfer these organs from the donor to the recipient. So they actually purchased this airline called Summit Aviation last year in order to streamline that process. I guess if you don't want to rely on an outsourced airline, just buy your own airline. Why not? I think that's very interesting. It's an interesting move. I'm not sure whether it's a good move, if it's genius, or if it's crazy. Sometimes the ideas that seem crazy are actually genius, and sometimes the ideas that seem genius are actually crazy, right? But anyway, back to the company. Revenue down quarter over quarter, up 64% year over year. However, we should expect that this next quarter is going to return to sequential growth because they kept their full year guidance the same. So is a 27% now drop after hours merited for slightly weak revenue in the quarter and for lowered gross margins? Does that justify a 27% drop? Well, let's find out. So this is my disruptive growth stock spreadsheet. I use this for analyzing growth stocks, which typically tend to focus a bit more on revenue growth as opposed to profitability. So sometimes it's really hard to value a company that's not very profitable. So I use this spreadsheet. It analyzes stocks on 4 factors, and those are gross margins, annualized revenue, price to annualized sales, and year-over-year revenue growth. So I give each of these factors a score from -1 to 5. So the best possible you can get is 20. The best on my sheet right now is 16.8, and my average is 11.6. So TransMedics gets 12.8. So you could conclude that this stock is a better value than little over half of the stocks on my spreadsheet. Now, why is that? Well, I put in their new market cap that they will be likely to open at if this drop persists, and I put in their new revenue number and their new gross margins. So gross margins above 50% for a company that sells a physical device, that's still very impressive. Typically with hardware-based companies, you see weaker margins just because there's going to be so much competition, and there are also increased costs of producing physical goods as opposed to software where there's nothing physical that you need to make. So 56%, not bad for TransMedics. Annualized revenue, I like to reward companies that are larger and more established that have already put the growth behind them. And I like to punish companies that are a little bit smaller because it's easier to grow your revenue when you're small, right? It's easier to turn 10 million into 20 million than it is to turn 1 billion into 2 billion. So TransMedics has annualized revenue of just under $500 million. So that's not bad for a $3 billion company. That gives them a valuation on a price to sales basis. This is price to annualized sales of 7 times. So I'd say for a growth stock, it's not unreasonable to see valuations in the double digits sometimes. Look at Intuit, price to annualized sales of 11, Shopify, price to annualized sales of almost 14. Keep in mind, those are software companies, but still, TransMedics with 64% year-over-year revenue growth and a price to annualized sales of 7, that feels reasonable to me. That does not feel steep. It doesn't feel like this stock is overvalued, but it also doesn't seem like a screaming buy at this particular moment. Sure, you do have to pay a premium for growth, and I understand that, but we also have to understand that a lot of TransMedics growth is likely behind them at this point. I say likely because anything can happen, but that comes down to the total addressable market for TransMedics products. So this is where you have to speculate a little bit. Is TransMedics likely to keep displacing ICE? I would say yes. I think objectively, the TransMedics device is a lot better than ICE for transporting organs from a donor to a recipient. I don't think that there's really anything to argue with there besides cost. Yeah, TransMedics is more expensive, but when their product improves outcomes this significantly, I think it's probably worth the cost. And even though ICE is cheaper than their devices, they claim that you can see a cost savings, and this is likely because you have fewer failures. So if you spend a lot of money trying to transplant an organ and it fails before you can get it into the recipient, that's wasted money. So if you don't waste money as often with TransMedics, it begins to pay for itself. So I think that TransMedics does have a good bit of growth that they can continue to capture. However, I'm kind of skeptical about how large the actual total addressable market is for this kind of product. Even if the total opportunity is only, say, $2 to $5 billion, that still gives them a bit of room to continue to grow their revenue. And their earnings report did say that they are making investments into their platform to prepare for future growth. So going back to the initial question, is this 20+% dip a buying opportunity, or is it just coming back down to reasonable levels? Well, even though the stock has performed incredibly well, I would say after the drop, the stock is reasonably valued. To me, I don't think it's a bargain buy, so I'm not going out to buy. But if this is a company that excites you, and if you think that they do have a bright future, I think this valuation makes a lot of sense. Again, going back to my spreadsheet, it's one of the more highly rated stocks on my spreadsheet, but also keep in mind that this spreadsheet looks backwards at historical growth and revenues. So if this growth begins to slow down, this score will drop quite quickly. However, as it stands right now, TransMedics does not look expensive. And if you're an investor who maybe really likes growth stocks and likes to see this really strong revenue growth and you have a bit more appetite for risk, maybe it's a nice buy for you. As always, this is not a recommendation to buy or sell TransMedics or any other stock, just my own findings and thoughts on the company. What are you guys doing with TransMedics on this earnings? Are you buying, holding, selling, or staying away? Let me know in the comments below. Thanks so much for watching, and if you're new, please subscribe. I post stock deep dives and other stock-related videos on a pretty regular basis. Thanks so much for watching, and I hope you all have an amazing day.